Hey everyone, today on the final bar, we're going to approach the markets as our normal Monday routine from three perspectives. One, the macro perspective, looking at the big picture charts, how they've evolved. From the sector level, looking at sector rotation, what sort of themes we can tease out there. And then from the stock level, and there's a lot of interesting moves in stocks, with some stocks breaking out, like Netflix, like Newmont Mining, but plenty of others approaching key resistance levels you're going to want to pay attention to. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks so much for joining me every weekday after the close to debrief on the technical news themes of the day and connecting the short-term movements of today to the long-term trends. Now, on Monday, I feel like normally the gap from Friday close to Monday open feels like a lifetime away, especially given all the news headlines and news flow that's come over the weekend. So a 3-day weekend with a holiday on Friday felt like a lifetime. So, lots of ideas to catch up on. As we've talked about, I spend time every weekend looking at through the S&P 500 charts, just looking at individual names. And that's what fuels one of the segments we'll do in a bit called Shifting Stocks. And it strikes me how many names are really at key levels. And also the fact that, charts that actually looked a little constructive on Thursday, when I looked at them over the weekend with fresh eyes, looked more like a bear flag, actually more negative. I'll show you some of the examples that I'm thinking about and hopefully see what you think as well. Coming up on our show here on the Final Bar and also elsewhere on Stock Charts TV, we have some fantastic content this week. Again, we're really fortunate on this show to bring on guests like Brian Shannon from Alpha Trends, who will join us tomorrow. Trevor Neal from the Beta Group will join us from London on Wednesday. Then on Thursday, Willie Delwich from Robert W. Baird. So we've got some very high quality, knowledgeable analysts giving their take on what's happening. And I hope their ideas can help spur some of your own thinking. Also very excited to share with you tomorrow and Wednesday and Thursday, forgive me, the 15th and 16th, we have our latest special event, the Big Board. We're doing it in two parts. This is based on our visit to the floor of the New York Stock Exchange last December. It's really, really well done. I've seen some of the previews of it, and you're really going to be impressed. A behind the scenes look at how the exchange operates, and so timely now with people working remotely and everything. Just seeing the history and the trajectory of the role of the market maker at the New York Stock Exchange. So check that out for sure. So thinking of a market recap, again, on Monday, what we like to do is hit the market from three directions. Big picture, which we'll start with first, then we'll go to sectors, we'll go to stocks. And this really mirrors what I would hope as you get more and more disciplined as a technical analyst, as a technically oriented investor. This should be, I hope, part of, just should inspire your process, how you kind of go through it. And for me, how I've evolved is Friday, when I'm getting ready for that Wrap of the Week segment on this show, that's when I sort of do the macro look, really digging into the big picture charts and some of the sectors. And then going over the weekend is when I look at a lot of individual stocks. And on Monday, I feel like I have a better sense of where the charts have evolved and where we're headed. So let's look at it from the macro perspective first. We'll do a quick market recap. We'll touch on some other things as well. And then we'll get into to the rest of things. So the S&P, after a big sell-off out of the open, and so the first hour and a half was relatively weak. Just after 11 o'clock ended up being the lows of the day. And since then, it was sort of a nice, sort of choppier but stepwise motion back to the upside. So, the losses cut about in half, but still down about 1% on the S&P. The S&P closing just above 2760. You then have mid caps and small caps, and I think it's noteworthy to see if we look at the small cap little preview chart, you can see this sold off as well, but then remained muted. So the appreciation in the second half of the day was really the mega cap, more the defensive part of the overall market, to be honest with you, as opposed to buyers coming in. So it certainly felt more like repositioning and less a real bid coming in off of the low. So the small cap index and the mid cap index both down over 3%. Today's sell-off has pushed the VIX back up to just above 41. So again, very much off the highs that we had a couple weeks ago, but still relatively elevated compared to where it's normally been. We're going to look at a couple other asset classes very quickly. So bonds actually went down midday. We're holding up very nicely, and then you can just see how it almost literally fell off the cliff here, with the TLT going down almost 1% and the 10-year yield and across the board yields essentially rising. Gold making a new 52-week high again today. If you look at the GLD, up 1.7%. Commodities as a whole up about the same amount. Compare that to oil, which is actually down 1%. So, this is certain parts of the commodity complex doing better. Energy and industrial metals, things like copper, actually mildly weak to a lot weaker. Looking at sectors, actually, tech was number one, communication services, consumer discretionary. All of these were essentially flat up a token amount, but nothing really meaningful there. So it's interesting to note that on a down day, you had technology, the number one sector. It's been one of the concerns is you've had these up days with tech actually toward the bottom of the list, kind of reversed here. And again, you can look at certain names like Netflix, which really drove things higher, but it was limited to a couple of sectors. The average sector actually down pretty meaningfully, with financials, I think, notably toward the bottom of the list. You have utilities, real estate, two of the defensive groups really leading the way down, and then financials second from the bottom. We're going to look in our shifting stock segment about some of those, some of the banks, some of the asset managers, which are all at some, really compelling levels, I feel like, sort of pounding out this short-term pattern of higher highs and higher lows, but within the context of a lower trend. We're going to get to stocks later, but I did want to point out that the number one rated stock in our StockCharts technical rating, the scooter rankings, no longer Regeneron. It had been Regeneron for quite a while now, actually overtaken by a gold miner, by Newmont Mining, which had a couple really significant days breaking to new 52-week highs. We'll look at that later, but worth noting there's a changing of the guard of sorts there. But a lot of the top 10 pretty similar in terms of the names that overall have been holding up pretty well. You can see Netflix is in the top 10 for sure, along with other things, semiconductors and others that we've talked about previously. In terms of themes, just looking elsewhere at a macro level to see what's been happening. So you had certain markets up in a fair amount. So Russia, frontier markets, Singapore up pretty good. The Chinese markets all about flat, up a little bit today. Looking at the common ETFs. At the bottom, you have Italy, Germany, and then the A shares out of China. So a lot of the top, or sort of the bottom of the list, are developed European markets, with EFA down almost 1% as well, similar to the S&P. In terms of industry groups, worth noting, automobiles, broadline retailers, these are two groups within consumer discretionary, both up very good. But then mining and gold mining, as we mentioned with Newmont Mining, and the strength coming out of there. Also semiconductors. So, one of the big, questions people have had is with semiconductors. And if you look, the chart overall has been appreciating, sort of that higher highs, higher lows. So on that tactical time frame, doing very well. The real question is this a short-term corrective move within the longer-term trend, which I'm afraid it's going to be. And I'll finish off with this, and then we'll look at some of the sector charts. What concerns me with the chart of semiconductors, along with many others, is when I'm saying a bear flag or a bear pennant, what you essentially mean is a big sell-off like you had here for 4 weeks from mid-Feb to mid-March. Then you have this sort of parallel motion, and it's not quite parallel, which is why it's a little more of a wedge. We have higher highs and higher lows. The range is narrowing a bit, but it's sort of this counter trend move. So you have the big sell-off, you have this counter trend move, and more often than not, this sort of comes down. And the way you measure it, and I'll quickly put a line on here just to show you what I mean. So if we take the lows here from mid-March, we connect it to the lows there. Sorry, this is very crudely drawn, but you get the idea. We connect those lows, that's our support line. And if and when we break down through that trend line support, that suggests a parallel move to this one, which would put, semiconductors way down here visually, which is pretty far way down, to be completely honest with you. So, again, that happens, that signal would occur if you would get below this trend line support. What concerns me with semiconductors a little bit, but more broadly speaking, is that a lot of charts kind of look like this right now, is if you break down through that trend line support, suggests, certainly further downside. You have some short-term lows between there. So on semiconductors, I think these lows from the beginning of April are probably most meaningful for that. But I think it's worth noting a lot of these markets, and semiconductors actually pulling right back up to the 200-day moving average and not able to really remain above it over the last week. potential area of concern. We need to move on to our next segment, though, which is sector setup. So what we love to do is look at the 11 S&P sectors. This is the second phase of the day here, sort of paying attention to some of these charts, and then we'll go to stocks next. So I'm looking at the RRG, the relative rotation graph. What strikes me here is technology. So as I'm looking at it going into the weekend, the fact that tech has pivoted from going, being the strongest sector further out to the right than anything by far. That gap has narrowed and narrowed. So as healthcare, as consumer staples, even as utilities, as real estate now have all been evolving to the Northeast, technology had sort of been stagnant. It had been holding up here okay. But now tech in the last couple of weeks has rotated southwest. And what that means is, it's rotating away from positive momentum. It's starting to underperform on that time frame, and the momentum is starting to build up on the downside. So it's suggesting a bit of a change in leadership. This is a theme we've talked about here, because we've had this situation with technology being relative strength and the relative strength of the XLK being consistently strong. And this is showing that there's some chinks in the armor in terms of tech's dominance, and it's starting to be overtaken by things like healthcare, consumer staples, utilities, real estate. Now, a couple of these obviously are very much sort of coronavirus themed charts. So if you go back to the special event we did a couple weeks ago, the pitch where we actually highlighted 15 stock ideas related to the coronavirus, there are a lot in those groups, right? Things like biotech, things like pharma, in staples, names that would be sort of the necessary goods you would need to ride out an extended homestay, all sort of in those sectors. So the relative rotation graph really reflecting that rotation in some way away from tech and into some of those other groups. Energy, again, is sort of a forget it until you get meaningful improvement according to this methodology, just really relatively weak. But I think even more concerning than energy, which we've known for a while, right, that it's sort of an outlier to the downside, industrials and financials. And I think that's one of the more concerning ones, just financials continue to underperform and be in that weaker part. So all of the recovery, all of the potential upside rarely has come from the financial sector as a whole. It's more of an opportunistic stock picking spot, but not a lot of great options there. I wanted to show you two sector charts here before we move on. Chart number one is looking at the XLF, the financial. So what's interesting with this chart, we're going to zoom in just to the last year. We're looking at 2 years there. Now we're looking at the last year. You can see this actually looks pretty similar to the semiconductors chart that I showed you. And again, this is what concerns me with financials, and we'll look later at things like JP Morgan, Citigroup, others are very similar. You've had this big move down, and it seems almost more glaring with some of the financial stocks. And then look at this parallel channel coming up here, which you'd call a bear flag or a bear pennant, depending on how you draw the lines and how strict you want to hold to that pattern. But usually, more often than not, this ends up being a holding pattern before the next big leg down. And the general measurement is you take the measurement going into the pattern, and that's the measurement you have coming out. The trigger for that is this trend line coming off the lows, which is what we just talked about with the SMH. So if you draw the same trend line, the XLF breaks below 21-ish in the next, couple days, couple weeks, which would take it below that trend line. That would be, a real potential negative signal for the sector, and I would argue for the markets as a whole. From there, sort of that point of no return is that most recent swing low. And if you would start to break that, so 1930 or so on the XLF would be sort of the ultimate signal. Today's action is certainly not inspiring confidence. After Thursday's nice rally, things feel very good. You see a bit of a retracement with financials and elsewhere. I wanted to show also the chart of technology. So again, on that relative rotation graph, you're getting the negative rotation that's really driven off of this sort of general change in slope here. If you look at the consistent uptrend, the XLF, arguably still in a pretty decent place, but now you have lower peaks and lower lows in the relative strength over the last, 4 or 5 weeks. And that's what's, it's rallied well, which is good, but the relative strength has come down because people have been really bidding up some of the other sectors instead. So now you have the XLF rolling over a bit on a relative basis, right at that confluence of resistance we talked about last week, 38.2 last Fibonacci level, also the 200-day moving average. So if there was a place where it would make sense for technology to roll over, and we haven't seen it yet, I feel like we're right about there, to be honest with you. But again, it's all about whether we get that follow through, whether we break down through the previous lows, or whether we're able to continue this pattern of higher highs and higher lows. And so it's all about the next pullback and where we're able to pull back to. Do we remain in this constructive pattern, or do we start to break down through trend lines on other measurements we've talked about? It strikes me as I'm finishing up this talk about sectors, I had hoped to talk about just the chart of the S&P, and I missed it because we were looking at some other things. So I just want to show you very quickly sort of what we're seeing. Now that you've heard the view on some of the other sectors, you can probably guess what I'm seeing with the chart of the S&P. Again, the concern is this parallel channel, this upswing that's come so quickly, sort of this V bottom pattern that has continued up. That's all good, and that tactical time frame, that short-term time frame, has been very constructive. But the long-term, more of the medium-term and long-term charts, still relatively weak. And now if you look at the S&P, we're in that purple zone, this blue zone, which is based on Fibonacci retracements, but also the lows from last August and last October. And I forget which of my guests last week really focused on that level, but it was pretty. It's worth reviewing some of the guests last week and what they saw about this reaction rally and where we've gotten to. So I think we're again at that point where you might expect some sort of resistance. Now we're looking at the 50-day moving average coming down as well. We need to take a quick commercial break, folks. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hey everyone, welcome back to the show. Thanks for joining me every weekday for the final bar. We're going to do a mailbag segment tomorrow, so please shoot your questions to me, thefinalbar@stockcharts.com. We'd love to hear from you, questions on the markets, on charts, on technical analysis, on behavioral finance, whatever. Happy to answer any questions we can. We've got some great guests and some great expertise to help address the things on your mind related to what's going on around you. So look forward to hearing from you. thefinalbar@stockcharts.com. Send us your questions anytime. Our next segment is called Shifting Stocks. And what I love to do over the weekend, as you've probably heard me say many times, is look through a lot of individual stock charts. And again, I found a lot of people tend to do one or the other more than, one or the other less than they should. If you think about a top-down macro view and a bottom-up stock pickers individual name type of view, make sure there's a balance in there. Even if you're just trading broad market indexes, there's a lot of signal in the individual charts and the individual stocks. And there has not been a major turn in the markets, I feel, that has not been reflected in stock charts first before you see it, because you'll see signs of evolution of trends in certain groups, in certain names, in key leadership stocks. And then the broad indexes will sort of recognize that things are evolving. So very, very important part of the process. We're going to start going through them. And again, what I do is, as I'm going, I'm sort of jotting down tickers on a piece of paper and then try to get through as many as we can. And I want to get through a number of them. So we're going to start in communication services with Disney. I think what hits me with the chart of Disney is the fact that it's facing resistance. A lot of charts have this parallel channel. You can see Disney, not so much. It's actually hit a pretty decent resistance level right around 108. And so if Disney is able to eclipse that, that'd be really positive in terms of, some sort of recovery. You can see on a relative basis, Disney's been pretty muted. It's made new relative lows last week. So it's not like it's been crushing it out of these lows. It's been sort of whimpering while other stocks have been much more vertical. So I think if it's able to eclipse that 108-ish level would be pretty meaningful. Again, this is a stock that's well below 2 downward sloping moving averages, so it's not the most attractive chart out there, but I like paying attention to charts that are really close to key resistance levels and see whether they're able to eclipse that. I think it's also worth noting what happens to the RSI here. You can see after that peak at the end of November, Disney has never really had an RSI above 60, which in a bear market phase, the whole range of the RSI kind of comes down a little bit. And so Disney still has been in bear market mode, even with this nice rally out of the lows, still sort of relatively weak. I think that's an important one, but facing resistance. In the same sector, we have 21st Century Fox, ticker FOX. This one looks about as clean of those parallel channels as I've seen. I mentioned this with a couple charts with semiconductors and elsewhere. And again, what I'm referring to is this, the move off of the lows. And in some ways, these are really easy charts to follow because it's all about, if the stock is able to stay above trend line support? And if it is, then don't worry, right? Still a great position, still a good long idea that makes sense. But if and when it starts to break below there, it's not a screaming sell necessarily, but what it does is it says it should be on your watch list. It should be on your review list to just determine whether or not you'd still expect further upside with it. So trendline support, I think, really key on Fox with this parallel channel coming out of the lows. Now, as you remember, probably within communication services, you have the media names, you have broadcasters, but you also have sort of the fixed line telecom names, AT&T, Verizon, CenturyLink, those sorts of things, internet providers, sort of all mixed in there. Verizon comes to mind as one that, again, I think it's right at that moment of truth. So the resistance in the first week of March had a big gap down, kind of bounced up and hit right around 57.50. We've now gone up to that. And Thursday, what I noticed is that it almost closed at the exact same level. And then today we pulled back a little bit and it had just finally gotten above the 200-day moving average. I'm thinking, boy, is this enough of a follow through that you think Verizon is going to go back to new highs? You know, all of a sudden today occurs and now it's, you know, in question. We don't really have the upside follow through yet. The RSI peaked right at 60. As we mentioned with the chart of Disney, this is what tends to happen when a stock's more in bear market mode. The rallies never really eclipse 60 on the RSI. Having said that, you also have this sort of bearish divergence with lower peaks on the RSI as the stock is going higher. So all of a sudden, Verizon feels a little toppier in the short term than it did, you know, when I was looking at it going into the weekend than when I reviewed it over the weekend. Now, also, we have some of the video game names. EA is Electronic Arts, Activision, very similar. These are a couple names that actually look pretty constructive relative to others. Again, similar issues in an RSI hitting 60, hitting a huge resistance area. That's what concerns me on something like Electronic Arts is how much would it take to propel this all the way to new highs? And you can see with Activision, kind of a similar type of pattern. So we're right at these key resistance levels, but again, if I didn't know what was going on in the broader market, I probably feel pretty happy with this type of chart in my portfolio. This is a stock that's come out of resistance in the low 50s, you know, never really, I'm sorry, support, forgive me, in the low 50s, you know, broke below the 200-day, but never really followed through, kept trading back above it. Now, all of a sudden, it's nearing 52-week highs. And I think at this point, you'd really want it to break above that 64.50, 65 level, which would bring it above the February high to really feel like there's upside follow through. So within communication services, actually some really interesting charts at key levels. I wanted to switch gears now and talk about financials because I think that's where there's some potential concern here. So BlackRock is an example of, you know, asset managers in general look pretty challenged at the moment. And you can see that BlackRock, after breaking to new relative highs at the end of last month, has sort of tapered off a little bit as other sectors have evolved and moved forward. You know, it's the relative strength has turned lower a little bit in the last 2 weeks. But if you look, it's right at a key resistance level, right? So BlackRock just breaking above the 200-day moving average on Thursday, breaking back below it today. So this is a couple times it's tried to beat the 200-day, has not been able to do it. All these stocks have retraced around 50% to 61.8%, sort of in that Fibonacci sweet spot, the level at which you may expect resistance to come in. So again, all of a sudden it looks like if there was a line at which, you know, if these stocks resolve lower, I think it would end up looking pretty straightforward in terms of this nice, you know, dead cat bounce, this nice rally out of the extreme lows before the next move down, the next leg down. And I think you're looking at resistance, you're looking at the RSI to determine whether or not that's actually playing out. Other stocks in the group, very, very similar. So State Street is another one that, you know, needs to eclipse its 200-day and its 50-day, has not been able to do so. RSI right at 60 again, which is pretty classic bear market mode. Fifth Third FITB is another stock in the group. This one not nearly as attractive as those other two, and this one certainly more of a bearish wedge type of pattern. This short-term higher highs, higher lows, but a consolidation of the range after the big move down. So Fifth Third almost, you know, you want to see, is it able to hold a higher low and use the trend lines that we talked about with semiconductors and elsewhere. The relative strength not confirming this most recent breakout, which is what jumped out at me on that chart. Wrapping up our discussion of financials, you know, the big banks I think are the most concerned, right? So JP Morgan, this feels very bear flaggy to me, to be honest with you. And I know that's not really an adjective, but that's the idea of this huge sell-off, the parallel rally, higher highs, higher lows. And again, a break below that support line would be pretty key. And so I think if you get a bear flag, if you get a validation of that pattern JP Morgan, I'd be very concerned about potential downside, to be honest with you. MasterCard's an interesting one. This is sort of, a tech / financial, sort of that fintech space, payment processors. We bucket them in technology, but you could easily justify putting them in financials. I think really, really key on MasterCard to be looking at the 200-day. It hit it last week, was not able to close above it. And I think whether or not it's able to do so will be fantastically important. Have we had enough constructive charts? Let's look at a couple that are actually lining up really in the positive to wrap up our discussion of shifting stocks. 3 to throw at you. Number one, Amazon, right? So if you look at Amazon, this is a stock that is testing new highs, new closing high for the 52 weeks. If you look today, it didn't quite make an intraday high, a new high in price, but a new closing high. The close is above the closes from early February. So this is a stock that is literally 100% retraced the sell-off from February to March and back up. And obviously Amazon is in a unique position to struggle in some ways, but also benefit from the whole lockdown challenges. And I think the big question, obviously, fundamentally, there's so many questions on all of these charts, but with Amazon, I know that 2-day delivery is in the past at this point for most things. And the question is, how much are people staying with it? The charts so far are telling me that people are pretty optimistic. Newmont Mining, so this is, as I mentioned, our number one stock according to our StockCharts technical rating. It's the percentile ranking of all the trends in the large cap space. Newmont Mining literally number one, up 4 1/3% almost today, making new 52-week highs going into the weekend, and then also confirming it. Not many stocks overbought these days, and Newmont Mining is one of them, but clearly in a bullish mode with a foot on the accelerator. And finally, if I'm going to look at constructive charts, I think you have to end with Netflix. If you're looking for a reason to be bullish, I'd probably start with this chart. If you look at the last couple of years, you have resistance right around here from late 2018, confirmed in mid 2019, confirmed a couple months ago, and now all of a sudden we're breaking above that in this huge cup and handle like pattern. So Netflix certainly one of the more bullish charts that I can come up with around the equity universe. So ladies and gentlemen, that is shifting stocks. So many great charts to pay attention to, so many key lines and levels to pay attention to. If you have questions, again, shoot them over email, thefinalbar@stockcharts.com. We'll answer them. We need to wrap the show, though, and go right to the 3 in 3. 3 charts, 3 minutes. Here we go. Chart number one is the S&P very long term. This is going back to 1926. And so we just got really into the weeds about this short-term bear flag patterns potentially evolving on stocks. But I wanted to remind you, when you're thinking about the investment landscape, I would mentally be thinking about this kind of chart first, right? So this is looking at the multiple, many, many decades, many, many cycles. And there's 2 reasons for this. Number one, all bear markets have been followed by a bull market. So at some point, I have very high confidence that we will make new highs. I'm just not sure when that's going to be. Number 2 is if you look at the RSI, the monthly RSI in the S&P never really got below 40, which is more in line with previous pullbacks within, cyclical bottoms within longer term uptrends. We break below those when we really get to the secular bear markets. We haven't had that yet, but having said that, the first sell-off during the Great Depression, the 1930s, did not get below 40 either. So it's not saying it can't happen, it's saying it hasn't happened yet. Chart number 2, and sorry we have to go quickly through these, is the GLD. I mentioned stocks making new highs, gold making new 52-week highs, as I mentioned earlier in the show. So the GLD continues to impress in a pattern of higher highs, higher lows, long-term uptrend, very constructive overall, at a time when stocks in general are relatively challenged. So pay attention to gold if you've not already. And then number 3, Netflix. We finished off our shifting stock segment looking at this chart. And again, if I'm trying to be bullish, which I'm not, you could probably guess from the way that I'm analyzing the charts or the way that what the charts are telling me, I'm finding a lot of stocks at resistance, a lot of stocks feeling like they're at that point at which a new leg down would happen. But Netflix is certainly bucking that trend, breaking above that long-term resistance. And now all eyes, I think, to the ultimate resistance from mid-2018. But overall, not many stocks making new closing highs, not many stocks in a cup and handle breakout pattern. Netflix is one of them. Ladies and gentlemen, that's our show for a Monday afternoon. Thanks so much for joining us every weekday. You can see all of our previous shows with our fantastic guests on our YouTube channel. Just look for Stock Charts. You'll find them there. Don't forget the Big Board, our new special on New York Stock Exchange coming up later this week. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.